market is an arrangement between people for trading what with one another. That is what market is. It's an arrangement between people for trading with one another. So please take note of that. So the type of market structure within which a firm operates is determined by what? By essential features or characteristics of the market. So when we're talking about market structure, so it depends on the structure which a firm operates. Are you getting it now? So the type of market structure within which a firm operates is determined by essential features or characteristics of the market. So what are those features? It includes the number of firms. How many number of firms? The extent to which the products of different firms are diverse or homogeneous. So when we say when we say that it is homogeneous, that is a situation whereby the same product that is what? That is of value, that is of different value. And also the ease of entry into it and exit. So there are some markets whereby there is what? There is entry, there is what we call free entry and exit. That is a market whereby you can easily come into it to sell whatever you want to sell, and you can easily leave if you are not selling again. So when we're talking about market structure, we are talking about the structure of which the number of firms that exist in that market, what type of product is being sold there, what is the quantity of product that is being sold. That is what we classify as, that is what we mean by market structure. And this can include what we classify as perfect competition. You need to understand what perfect competition is. You need to understand what monopoly is. You need to understand what monopolistic competition is. You need to understand oligopoly. You also need to understand duopoly. All of these that I mentioned is what make up market structure. So if you are being asked what market structure is, so all of these things can be classified under market structure. That is perfect competition, monopoly, monopolistic competition, oligopoly, and duopoly. So let's now start picking them one after the other. That is what we want to look at in this chapter. That's why we call it market structure. So what is the first market structure we'll be looking at? We have perfect competition. Perfect competition. So what is perfect competition? Perfect competition refers to the market structure in which there is a large number of relatively small firms. Please take note of that. Perfect competition refers to the market structure in which there is a large number of small firms. There is a large number of what? Relatively small firms. So each firms having freedom of entry into and exit from the industry. So when we say freedom of entry, that is, you can easily go into the market and sell whatever you want to sell. At the same time, you can also leave the market easily. That's what we classify as free entry and exit. And all firms produce homogeneous products. All the firms in the perfect competition market, they produce what? Homogeneous products. And all market participants, when we say market participants, we are talking about buyers and sellers. So all market participants have full knowledge. They have full knowledge of the situation in the market. That is, nothing is hidden for anybody in a perfect competition. Everybody is aware of the situation in the market, especially about the present price and location of the product. So in a perfect competition market, it's a situation whereby there is freedom of exit and entry. And also, all the participants, at least those that are buying that and selling, they have the full knowledge of the situation, especially when you're talking about the price. So the price is not hidden. Everybody is aware of the price. Everybody is aware of what type of product that is being sold in the market. Everybody is aware of the location where we can get each type of product. That is what we classify as perfect competition. That is, there is no hidden agenda. There is nothing hidden for anybody in a perfect competition. All the market participants, all the buyers and the sellers, they have full knowledge of the situation in the market. So we have characteristics of perfect competition. So what are the characteristics of perfect competition? Number one, we have large number of buyers and sellers. Large number of buyers and sellers. That is, one of the characteristics of perfect competition is that we have many large number of buyers and sellers. So there are many buyers and sellers in the market to the extent that no single buyer or seller can influence the product price. That is, all buyers and sellers are described as price takers. So in a perfect competition market, one of the characteristics is what? There is large number of buyers and sellers. That is, no one person cannot influence the price. Everybody is aware. So nothing is hidden. That is one of the characteristics. Then the second one is what? Homogeneous product. So what do we mean by homogeneous product in the perfect competition? The product of all firms must be identical in the eyes of the consumers. That is, if for example, you and I were in a perfect competition, or whatever you are selling must be the same with what I'm also selling. So it means nothing is hidden. You cannot hide any product in the perfect competition market because it is what you are selling that I'm also selling. So they know the price, they know the quality of the product that is in the market. So it is identical, it is similar in the eyes of the consumers. Then we also have short run equilibrium of the perfectly competitive firm. So short run equilibrium. So what is short run equilibrium? They said a firm is said to be in equilibrium at the output level where there is no incentive to alter output or supply decision at the profit. That is, when we talk of equilibrium, short run equilibrium, we are talking about a situation whereby the output, that is the product that is being supplied, that is being sold. Are you getting it now? So is what? Is the product can give in profit. The quantity of product that is being sold in the market is at which they can maximize what? Profit. Profit is being made based on the output that is being what? Sold. Based on the what? The quantity that is being sold. So that is where they can make more profit. And one of the rules in order to maximize profit is that the firm, that is the seller, will achieve the maximum profit at the output level where marginal cost is equal to marginal revenue. And I remember I mentioned that marginal cost is the cost of the extra unit of product that is being what? That is being produced, whereby marginal revenue is the what? Is the revenue that is being what? The extra revenue that you realize on the extra unit that is being what? Produced or sold. So that is for short run equilibrium in a perfectly competitive firm. Then we also have long run. So in the long run, so what we are talking about in the long run is that the existence of positive economic profit in the short run will encourage new firms. So that is, the more profit that you make, this will attract more firms. This will also make more firms to want to join the industry, because when they see that you are making more profit, people will also be willing to what? To come into the industry to also sell, so that they can also make profit. So, and don't forget that you mentioned that when there is what? there is free entry. That is, there is no barrier, there is no hindrance, there is nothing that can affect people from coming into the market. So you understand, that's what we mentioned under perfectly competitive what? Market. That is a market where anybody can come into the system to sell and anybody can leave. So in this situation, so under the long run equilibrium, that is, people are encouraged based on the fact that they discover that people are making more profit. So they decided to also come into the what? To the industry, because they know that there is no barrier, there is no hindrance to what? To entry and exit. So what are the advantages and what are the disadvantages of perfect competition? Number one, goods are sold at the lowest possible what? Price. So the absence of barriers to entry makes it possible for new firms to emerge when positive economic profits are being recorded. So when they say that there is profit in the industry, so you know, when there is profit, when they are making profit, more profit, so it means there are many people that are selling that particular product, identical product, and there is profit. So which means the goods is surplus. So if one person did not have, they can easily get from another person. So that's why we call it free entry. So they have surplus sales, surplus supply. So they have access to the product and the product is very cheap. So that is one of the advantages of perfect competition. Then there is efficient utilization of what? Of resources. There is efficient utilization of resources. So every firm are price taker. That is, price taker means everybody have access to the price of the product. So nothing is hidden in the market. So another one again is what we call sales promotion is less expensive. So in a perfect competition, products are homogeneous. That is, products are they have identical products. So in the eyes of the consumer, so they can see the product as identical. That is, they can easily have access to the product. So it means there is nothing like expensive advertisement, because what are you advertising when you can easily have access to the product? So it's not going to be to make the advertisement to be expensive. It's not going to make it to be what? To be expensive, because of the fact that everybody have access to the product, is a perfect competition. That is, the good is surplus, is sold in what? In surplus, in quantity. So because of that, it means there is free access to the product. Are you getting it now? So that is another advantage. Then also, we also look at the disadvantages. We look at disadvantages of perfect competition. Number one is that firms make little or no profit. No, you know, we have surplus people selling. You are selling, I am selling, another person is selling. So in a situation whereby we have 10 people selling, it's just like we have Indomie. So we have 10 people that are selling Indomie in the same street. Let me use that as an example. 10 people selling Indomie in the same street. So how do you think that product will look like? So it means it's not a scarce product. If A did not have, I can get that product from B. If B did not have, I can get for C. So it means nobody can do shakara. So we have access to the product. There is a perfect competition. You understand? So in that case, there won't be too much of profit, because what everybody can easily have access to. So it means the price will be cheap. So that is one of the disadvantages. So firms, those selling it, they make little or no profit. So then there is also what we call invention and innovation are not encouraged. The absence of barriers to entry promote technological theft, which in turn discourage invention and innovation. So there is no barrier. Barrier means anybody can just come into the system and sell. Anybody can just join the firm and start selling, can just join the market, the industry, and start selling. So in that situation, there is no innovation, but it is whatever is available before that they keep on selling. There is no room for innovation or invention. Then we also have social cost. We have social costs are disregarded. The firms equate its private cost to marginal cost in determining the optimum output. So this means that the social costs resulting from negative externalities, especially environmental pollution, are not considered in determining the actual benefit of an. So what we are saying there is that there is no cost, there is no social cost. Social cost in the sense that everybody are just selling at their own price. There is no price control. So you cannot fix a price. Anything, if for example you fix a price that is too high, it means you are going to lose people that will be patronizing you. So because where you are increasing your price, you have other people that are willing to sell at cheaper prices. Do you understand? And because whatever, it's not that whatever you are selling is different from what I'm saying. We are selling identical products, and this product we are selling and product I'm selling is of the same quality. So if you are not selling your own at 500 naira, for example, I'm selling my own at 200 naira. So what do you think people would? People will prefer to buy from me because the product is the same quality. So there's nothing different from the product. So people will always want to buy at cheaper prices. So in that situation, they will disregard. They disregard buying at what? At high prices. So that is why we say that the market participant, the buyers and sellers are price what? Takers. So they are aware of the price. Nothing is hidden to them. Then there is also the problem of income inequality. There's what we call income inequality. So our income cannot be the same because in the long run, some entrepreneurs who have access to bigger financial capital will adopt cost-saving technology, lower price, and drive the smaller firms out of it. So you can easily now. So some people have money to do the business more than another person. So those that have money to do it, so they are going to have much supply. They are going to have much supply. In a situation whereby you are struggling to supply 10, for example, now, we have some people that can supply 100 at once. So these are all of the disadvantages that may come up. So having a look at perfect competition, another market structure we have is monopoly. You need to also understand monopoly. So Inechi, are you with me?
Yes, I am.
Okay, so we've looked at perfect competition. Perfect is one of the market structure we are looking at. So we've looked at perfect competition. So we want to also look at monopoly. So what is monopoly? Monopoly is the opposite of what? Perfect competition. Remember I said that in perfect competition, there is free entry and exit. So people can come easily into the market to sell, and people can leave. That is under perfect competition. But under monopoly, monopoly is just like the opposite of perfect competition under market structure. So monopoly is the exact opposite of perfect competition. So what is monopoly? Monopoly structure in which there is a single firm. You know, if you say perfect competition, we have many firms in the industry. But under monopoly, we have a single firm, only one person, producing a commodity or providing a service that has no close substitute. So under monopoly, we have single seller of a product, only one person selling a what? A product in the what? In the market. That is monopoly. So what are the characteristics of monopoly? Number one is that one firm in the industry. Please take note of that. In monopoly, we only have one firm in the industry. A poor monopoly is an industry consisting of only one firm. So that is the characteristics of monopoly, only one firm in the industry. Then there is barrier to entry. Unlike perfect competition, whereby we say there is no barrier to entry. There is free entry and exit under perfect competition. But in a monopoly, there is barrier to what? Entry. In order for a firm to maintain its monopoly position, barrier exists to prevent the entry of new firms. So we said only single firm, only one firm. So in that situation, that there is what? There is barrier. That is, it's not a market whereby anybody can just come and sell, unlike that of perfect competition. Then another characteristic is that there is absence of supply curve. When deciding how much to produce and what price to charge, the monopolies simultaneously consider demand and cost. So that is, the market participants under monopoly, they are not the price taker, because it is this price that I want to sell that you must buy it. Don't forget we said it is only one single what? Single firm. So it means it is whatever I say that you want to buy, you must abide with, because there is no free entry. If I cannot get the product from you, it means I cannot get the product from any other place. That is what monopoly is. But perfect competition, if I cannot get the product from you, I can get it from another person, because the same product is what we are all selling. But in monopoly, it is not like that. If you don't have the product, it means I cannot get the product anywhere. That is monopoly for us. Then we also have another one again, another market structure that we call oligopoly. What is oligopoly? Oligopoly refers to an industry. Oligopoly is an industry or market with a few firms. Oligopoly is a market with a what? With just a few firms that are selling products that are either homogeneous or differentiated. If you remember, I mentioned that under perfect competition, we have what? We have what? Many sellers that are selling what? Identical products. Then when we talk of monopoly, we say we only have one single seller and there is no free entry and exit. Then under oligopoly, we only have few firms that are selling what? Different products totally. They are not selling similar products. They are not selling identical products. So there are only few what? Sellers. And the firms are so few that the action of one firm affect the decision of other firms. So that is oligopoly for us. So anything that you, for example, let's say you are in the market, I'm also in the market. So anything that you do will affect my own decision. If you should increase the price, are you getting it now? It will affect me. By the time as you are increasing the price, me, I cannot reduce the price. If me, I'm reducing the price, you cannot increase the price. That is what oligopoly is. Number one is, one of the characteristics of oligopoly is that there is what we call interdependence. There is what we call interdependence. That is, there is mutual interdependence among the firms. That is, we don't do the same thing. We do different things. Another thing again, another characteristic is what we call barrier to entry. There is barrier to what? Entry. That is, there is no free entry and exit. Then we also have advertisement. Unlike that of monopolistic competition, oligopolistic firms also strive to achieve product differentiation and higher proportion of the market share through intensive advertisement. Then there is also what we call differentiated product. The firms in the oligopolistic industry may produce either identical or differentiated products. Firms in the steel and banking industry produce virtually identical products, whereas firms in the automobile industry are characterized by what? Differentiate. So what we are saying is that under oligopolistic, they produce what we call what? Differentiated products. Then there is also what we call lack of uniformity. There's what we call lack of uniformity. The firms in the industry differs considerably in size. The industry is highly concentrated as a result of several kinds of what? Barriers. So in oligopoly market structure, there's what we call barrier. And this barrier will prevent new firms from entering the industry. Because it has what? Large percentage of output produced by NIF. So it means under oligopoly, there is what we call large production. But as there is large production, there is barrier, there is restriction. Restriction means anybody cannot just come into the market. There is no free entry and exit under oligopoly. The only place where there is free entry and exit is under perfect competition. Even under monopoly too, there is no free entry and because that one is only single seller in the market. So there is also what we call absence of unique pattern of pricing behavior. Absence of unique pattern of pricing behavior. So that is what we have. Then we also have another one, like, apart from oligopoly, we also have duopoly. What is duopoly? Duopoly is a special case of the theory of oligopoly. So duopoly is a market structure in which only two firms constitute the industry. That is, they produce the entire market supply. A change in the price or output policy of one will affect the other. So under oligopoly, we said only two firms. They only have only two persons in the industry. So having looked at that, this is what we have under market structure. That's all what we have. That's how we call it market structure. So by this, we've ended this particular chapter. So now we are going to move on to another chapter today. So which we'll be looking at national income. Looking at which is an interesting, very interesting topic. So but before we move on to that, so let's take a few minutes to review what we've been able to discuss under this chapter. So Inechi, so how many market structure have we mentioned? And in brief, what and what can we say about those market structures? So how many are they as we've mentioned so far?
We talked about four
Okay, yeah,
market
list them.
structure. The perfect market structure, um, monopoly, oligopoly, and duopoly.
Okay, so we talk about perfect competition, we talk about monopoly, we talk about oligopoly, we also talk about duopoly. So how can you explain duopoly?
In duopoly, unlike the others, there are only um, two firms that are in the industry. They dominate the market.
Okay, how about monopoly?
Okay, monopolies, it's there's only one firm that produces the commodity or the service in the market.
Okay, thank you. How about oligopoly?
Um, okay, in oligopoly, there are more than one firms. There are a few, but not many. There are a few firms that are producing and
All right,
selling those particular goods and
all right,
services.
all right. How about the last one? Perfect competition. So how can you explain perfect competition? And what do you think? What make perfect competition different from the remaining three?
Okay, in perfect competition, there are plenty or there are many firms that are producing the same type of product, and in this market now people are free to go in and out of the market, unlike the other market structures.
All right. I like the fact that with all of these things you just said. So like I always tell students that one thing is that you see sometimes you don't really need to let me I always tell students you don't really need to climb, but once you can understand the idea or the concept behind, you are good to go. All what you have said, and that is exactly how it is. So in a perfect competition, there is free entry and exit, while the other ones there is no free entry and exit because there is restriction. Restriction means you cannot anybody cannot just come into the market and anybody cannot just leave the market. And the market participant in the other ones, unlike private competition, they are not the price taker. But in the private competition, the market participant, at least those people that are buying and selling, they are the price taker. At least they can decide to say yes, they are not buying because they have option. They know if A decide to sell his product as 50 naira and they are not ready to buy, they can go to another place. They have options. I know when you have options, you feel like you are a king. You feel like you are the king. But the reason why you don't have option, it is whatever amount you say you are selling it, I don't have option than to buy. So that is all what market structure is all about. That is what is all about. So there is nothing that is more than that. Market structure is such as very simple as that. So you just need to also at a time look at it, understand the characteristics, understand the advantages, and understand the disadvantages. So with that, you are good to go. So is there any question? So before I want us to move on to another chapter now. That is all about market structure. That's all. So is there any question?
No question for now. Thank you.
All right. So let's just without taking too much of our time. So let's just move to the next chapter that we have. So let's move on to the next. Can you confirm that you can see my screen now? Please confirm that you can see my screen.
Yes, I can see it.
All right. So now we're looking at national income. We want to be looking at national income. Then this national income, we are going to be looking at it in two phases. So we look at one phase tonight. Then by God's grace, tomorrow we're looking at another phase of national income. So today we are just going to be looking at the introduction part, the introductory part to national income. We'll be looking at introductory part to national income. Now, in a if you are asked, look at it, national income. So two things are together now. You look at national, you look at income. So before I explain what it means, what is your understanding of national income? How can you explain? Let's assume that you are being asked, what is national income? So how can you explain? Looking at the name.
From the words, I would say national income is the amount of money that comes into an economy or a nation.
Okay, well, you've tried. So when we talk about national income, look at the definition of national income. So national income is a term used to measure, look at the definition, it's used to measure the monetary value. So national income is used to measure the monetary value of the flow of the output of goods and services produced in an economy over a period of time, usually a year. So when we talk about national income, we are talking about the aggregate. Aggregate means the total value. I don't know if you are getting that definition now. National income is what? Can be defined as the what? As the total monetary value of what? Of output of goods. Total monetary value of what? Of goods and services produced in an economy or in a country over a period of time, usually a year. I will repeat again. National income can be defined as the monetary value of what? Of goods and services produced in an economy over a period of time, usually a year. So can you now define national income now, Nechi? So what is national income? What is national income? Oh, I mean, Nechi is sleeping. Don't sleep, oh.
National income is the total, the aggregate monetary value of goods and services um, produced in a country within within a period of time.
Usually a year. So you always put that clause there, usually a year. Why we say usually a year is because it's measuring it. Well, we are still going to get to where we'll be doing how we'll be measuring national income. So you show that you can know that it is usually a year. So let's move on to what are the concepts? What are the basic concept of national income or basic national income concept? So one of the concept of national income you should know, that you need to know, is what? GDP. GDP means gross domestic product. So gross domestic product is a concept of national, is one of the concepts of national income. And what was national, what was the meaning of GDP? Gross domestic product. GDP measures the total output in the domestic economy. Domestic economy means your country. For example, if I ask you that, what is your domestic economy? Your domestic economy is what? Nigeria. That is your country. That is what we mean by domestic economy. Economy here is talking about your country. So GDP measures the total output in the domestic economy. It is the total value or total monetary value. GDP is the total monetary value of all final goods. Please take note of that. All final goods. All final goods and services. All final goods and services produced within a country during a specified period of time, usually a year. It includes all the output produced by local and foreign-owned firms. Domicile means within the economy. So when we are talking about GDP, we are talking about all the monetary value of goods and services that are produced, that are what? Produced within the what? Within the country. Talking about all the value of goods that are produced within the what? Within the country. And it also includes those that are produced by local and foreign-owned firms. So when I say local and foreign-owned firms, if you look at Nigeria now, you see that there are some, for example, there are some Chinese company, like all these Chinese restaurants and others that are in Nigeria. Shey you understand now? So all those companies are not owned by Nigeria, but they exist in what? In Nigeria. They make their sales in where? In Nigeria. So if you want to calculate or measure the GDP, you are going to factor their own too. Why? Because whatever sales they make, they are making it in what? Within the country. So it means they will be part of the GDP if we are to calculate the GDP. So we also have nominal GDP, we have real GDP, we have potential GDP, are three different measures of aggregate output. So when we are talking about GDP, or when we are measuring GDP, you need to understand these three things. Please, they are very important. When we are measuring GDP, these three things, they are very important. So we have nominal GDP, we have real GDP, and we have potential GDP. So what is nominal GDP? What is nominal GDP? Nominal GDP is the market value, of all final goods and services produced in the domestic country in 1 year period at current prices. Please take note of this. I repeat again. Nominal GDP. When we hear nominal GDP, is what they can ask you in exam. So nominal GDP is the market value of all final goods and services produced in the domestic economy in 1 year period at current prices. So by this definition, please take note, only output exchange in a market is included. Do it yourself services such as washing your own clothes are not included. So when we are talking about nominal GDP, what you should understand is that we are talking about nominal GDP. We are talking about those output that is being done in the market. For example, now maybe you take your clothes to a dry cleaner. You know you are going to pay dry cleaner, yes or no, Inechi? If you take your clothes to a dry cleaner to wash it for you,
Yes.
are you not going to pay? You will pay. But those ones that you wash by yourself, shall you understand now? That one is not going to be part of what? GDP. So it means nominal GDP means the one that you exchange in the market. That is nominal GDP. Then we also have another one again, which is what? Output. That is, output is valued in its final form. Output is in its final form where no further alteration is made to the goods, which will change its market value. So this output value is what we classify as what? Real GDP. Real GDP means the final value of what? Of the goods. That's what we classify as what? Real GDP. While the other one is what? Potential GDP. So output is measured using the current year price. So that is potential GDP. So having understand GDP now, another concept of national income is your GNI. GNI, or you call it GNP. Please take note. GNP means gross national product. So this GNI is the same thing as what? GNP. Please take note of that. It's the same thing as GNP. GNP means gross national product. So gross national product is different from GDP. They are not the same thing. So what is GNP or GNI? GNP is the market value is the market value of what? Of all final goods, and services produced by the nationals of a country, during a specified period of time, usually a year. So GNP means, that's why we call it gross national. It's talking about those final goods and services produced by the nationals. Nationals means those that are within a country. For example, in Nigeria, let's say we have somebody from China, somebody from America in Nigeria now. You know, Americans and China that are in Nigeria, they are not nationals. Are they nationals? No. You understand now? So that is, those people that are from China that are in Nigeria, whatever value of goods they produce or that they sell, it will be part of what? Gross national product. Why? Because they are within the country. Do you understand now? So it follows from the definition that all goods and services produced by the nationals of a country within or outside, can you see now? Within the country or outside the country are embodied, that is, they be calculated in the GNP. Take note of that. So after that, we also have net national product. What is net national product? The word net in accounting means you subtract something from it. So net national product, NNP, is the net money value of final goods and services produced in an economy in a time period, usually a year. It is obtained. So how do you calculate NNP? It is obtained or calculated by deducting capital consumption allowance from GNP. So for you to calculate NNP, NNP is equal to what? Is equal to what? GNP minus what? Minus capital consumption. So that's the formula for calculating NNP. This formula for calculating NNP. Look at the formula on the board. So you say NNP is equal to GNP, that is your gross national product, minus capital consumption. So another concept again is national income, that is NI. This is the sum of all incomes earned by the factors of production in the economy during a specified period of time, usually a year. The national income measures the cost of the economic resources which have gone into the current production of this year output. It gives us the value of output at factor cost rather than at market price. Factor cost means the cost of what? Factors of production. So that is for national income. Then we also have another concept again. We have personal income. In nature, are you there? We have national personal income. So what is personal income? From the word personal, personal income is the totality of all incomes, including what? Transfer payment received by household. Household means individual, you and I, before payment of personal income tax. It is designed to measure the amount of income that individuals actually received in an economy during an accounting period. So how do we calculate personal income? Personal income is obtained by deducting all incomes earned by persons but not received from national income and adding all income received but not earned to national income. Income that are earned but not received are grouped into. So what we are saying is that for you to calculate personal income means PI. Personal income means what? PI. What they are saying is that to calculate personal income, you are going to subtract, you will say your NI means national income. So national income minus what? Social insurance contribution. And what is social insurance contribution? Social insurance contribution is the mandatory payment. Mandatory means a compulsory payment made by employers, employees, or both to government managed social insurance scheme. So there's something we call pension. Have you heard about pension before?
Yes.
So pension is, thank God that you've heard about it before. The pension is an example of this social insurance contribution. You see pension anywhere you are, if you are working under someone in a company, so pension is a mandatory payment. They will deduct it from your salary. So they will deduct 8% of your salary is what we call pension. Then your employer, the person that employ you, will also pay 10% of your salary. So your employer will be the one that will be paying that one. But the one that they will deduct from your salary is 8%. So that pension that we just mentioned now, are you getting it now? So it's not only pension, payee too. You know what they call payee? Pay as you earn. That is tax. So that one too, they will deduct it. All those money is what we classify under social insurance. Then we also have company tax. Company tax. Company tax is like, there's something we call CIT, company income tax. So company income tax is a tax that you pay if a company do business and they make profit. So 30% of that profit is what we call company tax. That's why a company pays a certain percentage of their declared profit as taxes to who? To the government. So what is left to be distributed to shareholders or to be reinvested is profit after tax. So this one will be subtracted. Then we also have undistributed profit. This is talking about those things that you will subtract from national income in order for you to get your personal income. So what is undistributed profit? Undistributed profit is a part of your profit. So part of your profit that you earn but are not paid out as dividend to shareholder. So when you make a profit, instead of you giving that profit to the shareholders as their return on what? Investment, you now decide to that money you invest it again. That money that you have made as your profit, you now invest that money into that business. You did not share the profit with the shareholders. You now invested that money back. So that's why you call it undistributed profit. So how do we calculate PI? PI means personal income. So personal income is equal to what? National income minus social insurance contribution, which I've explained here, minus what? TC means company tax, minus what? Company TC means company tax. So minus or plus what? TR. TR means transfer payment. Transfer payment. That's been, so this formula is the formula that is used to calculate personal income. Personal income. So then we also have personal disposable income. Please take note. Personal income is different from personal disposable income. So what is personal disposable income? Personal disposable income is the amount of money that an individual or household has, the amount that you have left to spend or the amount that you have left to save after you must have paid tax. After you must have paid what? The tax, social insurance contribution. So if you have paid those two, the money that is left is what we call personal disposable income. So personal disposable income equals personal income minus personal income tax. So if you look at this personal disposable income and this personal income, you look at it and say, are they the same thing? No, they are not the same thing, because in your personal income here, Are you getting it now? You are going to subtract what? Transfer payment. But under disposable income, are you getting it now? Look at the formula for calculating personal disposable income. The formula is what? Personal income minus what? Tax. Minus what? Tax. So if you want to calculate your personal disposable income, so whatever that you get here, anything that you get as your personal income, you will now subtract tax from it for you to get personal disposable income. Please take note of that. Then what are the method of calculating national income, of computing national income? Number one, so we have three methods. Please take note of that. You can be asked in exam. There are three methods of calculating national income. We have three methods of calculating national income. The first one is what we call product output method. Product output method. The second one is the income method. And the third one is the expenditure method. And for you to know which method to use, it depends on the what? The data that you are given in the question. The data that is given in the question will determine which method you have to use. So the first one is the product output method. The first one is the product output method. So under this method, the value of goods and services in a given economy during a particular period or a particular year are added together. They are added what? Together. So the first stage is in the aggregation process is to determine the value of goods. So under this product method, that's why I call it product method. It is called product method because you want to add together all the value of final goods. All the value of final goods is what you want to add together under the product output method. So, and how do you calculate that? Look at the formula here. Look at the formula here. Can you see the formula here? So if you want to calculate using the product output method, so the formula is going to be what? It's going to be GDP minus what? Indirect taxes plus subsidies. Indirect taxes plus subsidies. So you will see all of this. If you are given a question, you will see your indirect taxes there. You also be given, and you will have to calculate national income using the what? The output method. So another one again is what? The income method. The income method. Under this income method, so we are looking at what is the sum of the final income that is being earned by factors of production located in the country for what? For the production of goods and services for an accounting period, that is for a year. For a year. So that is the income method. We are going to look at an example, not today, but probably maybe tomorrow. So we'll look at one example and for you to be able to understand it better. Then the third one is the expenditure method. The third one is the expenditure method. And what is the expenditure method? Look at the formula here. So under the expenditure method, GDP is the sum of the final expenditure on goods and services produced in a country measured at market price. So under this expenditure method, there are four things you need to know. So what are the four things? We have the first one, household consumption. That one is represented as what? C. So whenever you see C, you're talking about household consumption. We also have firms. Firms, that is represented as what? I. Then we also have government. Government is represented as what? G. And we have the foreign sector. What is foreign sector? That one is talking about X minus M. X minus what? M. S represents what? Export. While M represents what? Import. So the formula for calculating national income using expenditure method, the formula is here. Look at the formula here. This is the formula that we use to calculate national income using the expenditure method. We say GDP is equal to C. And I told you that our C represents what? Consumption. C plus what? I. I represent what? The firm. It's either you call it the firm or you call it investment. Please take note. I represent investment. G represents what? Government expenditure. Plus S represents what? Export. Minus M represents import. All of these things, if you'll be given each of them in the question, then you'll now be required to calculate national income using the expenditure method. This is the formula that you will use in doing that. Then we also move on to the next one. So we look at what are the problems. All of these, by the time we pick a question, so you are going to understand it much better. So then we also have what are the problems of measuring national income. What are the problems of measuring national income? So one of the problems is what? Problems of double counting. So that we call it multiple or double counting, when you count more than one. So this has to do with intermediate goods, intermediate expenditure and transfer payment. There is the likelihood of valuing, for example, cassava and garri, counting expenditure on materials for making sweet, as well as the sweet and counting income earned. So what we are saying is that instead of you to record, for example, 5, you now record 5 as 10. So meaning that you have added it twice. The value of, for example, the value of garri now, you now going to add it to the value of what? Cassava. So all of these are one of the what? The problems. Then we also have marketability of goods. National income is the money value of goods and services in a given period. So another problem is depreciation. Another problem is what? Depreciation. Because if you want to calculate our net national product, so you subtract depreciation from what? From our GNP. So don't forget that to calculate NNP, for you to calculate NNP, so NNP is equal to what? Gross national product minus depreciation. This can be a question in exam. For you to calculate NNP, NNP means net national product. So how do you calculate net national product? You say GNP. GNP means gross national product minus depreciation. You'll be given depreciation in the question too. So another problem again is inadequate statistical data. Inadequate statistical data. We also have price level changes. National income is measured in terms of money, whose value changes from time to time. Then we also have national income records, legal incomes of goods and services. So sometimes national income, we are supposed to only record legal items. What are legal items? Items that are what? That are legal. What are illegal items? Like all these drugs, items that are not government binding, so that you are not allowed to buy and sell. So some of them are recorded as part of national income. So it creates a problem. So then what are the uses? I don't look at the problems. We also look at the uses, or what are the use of national income. Number one is what? It is used as what? As an indication of economic welfare. So you can use it to ensure that yes, is the economy growing or not. So with national income, you can use it to be able to measure that. It can also be used for economic planning. So national income can be used for what? Economic planning. Then it can also use to what? To approximate potential demand. So it can be used to approximate potential demand. So all of these are what we classify as what? Uses of national income. So and I think with this, we are also done with part, not all, part of national income for today. So is there any question? Because I have one or two things to as well say. But let's see, let's take a question. If you have a question before I go ahead.
No, I don't have any question.
Okay. So this particular slide, do you have access to it?
Yes, I do.
And you are able to open it, right?
Yes.
So what are we are, I will appreciate you. Please, probably tomorrow. So I want you to go through this slide again, this particular slide, this chapter 8. So at your free time tomorrow, before tomorrow night, please go through it. So I want you to read it and go through all of the slide again. Do you understand? And so that tomorrow class,
Okay.
by the time we start, so I want you to be able to understand it more than the way I've even explained it. So please, at your free hour tomorrow, go through it very well. Please go through it very well so that tomorrow, by God's grace, so when we meet, by the time I will now be taking you to tomorrow class so that you'll be able to understand it more and more better than the way I've said it. So, and again, please be informed that we are going to be having class tomorrow, same time tomorrow, please. So I will, maybe I will see if I can, I will call Clifford tomorrow morning. I want to see maybe the reason why he's unable to join was he didn't join our last class too. He didn't join our last class. So please be informed that we are going to be having class tomorrow. So the link will be dropped tomorrow. And please, while we are having our class, please endeavor to take your time to start looking at the past question, please. So that by the time you look at the past question, any of the past question, and like I always say, if you feel like you don't have any question, you can just call my attention to it, or you can drop it on the WhatsApp group. So it's very important. So your exam is less than, I think, let's say a month's time now. So we have limited time now. And we may need to be having class, like I told you, it will be mostly in the night, so that you can be able to have time and also to avoid all sorts of distraction. So I pray that God Almighty will make it easy and you will accomplish your your aim. So by God's grace. So is there any question for tonight?
Thank you very much. I don't have a question right now.
Okay. But please, like I said again, please make sure you go through the slide. Maybe probably have when you are free tomorrow, before tomorrow class, please. And if there's any way you can as well reach out to Clifford. Do I will also try and reach out to you tomorrow morning by God's grace. But you can as well reach out. So let's know why he didn't join the last class, and I'm not also seeing him in the class now. All right, in the absence of no question, so I wish you a blissful night rest, and please have it in mind we'll be having class tomorrow, same time tomorrow. So the link will be dropped on the group. So thank you very much. So have a good night rest.
Thank you. Thank you. Good night.
You are welcome. Good night.